So it's no big secret that you can only spend the dollars you keep in your pocket. So you need to be familiar with the rules about when and how much you might have to pay in taxes on your Social Security benefits. Hey there, I'm Devin, and this is my YouTube channel where I break down Social Security so you can get every nickel in benefit that you deserve. If you're new here, be sure to subscribe and hit that notifications bell so no new content slips by without you knowing. So several times a year, I hear from people who retire and are faced with sticker shock when they find out just how much they'll have to pay in taxes on their Social Security income. Now, I haven't found anyone that likes it, and at face value, it almost seems like double taxation. I mean, after all, you paid a tax as an entry ticket to get Social Security benefits, and now you have to pay taxes again. Now, I don't want to get into the topic of double taxation here. I actually have a separate video that covers that topic, which does have a surprising conclusion. I encourage you to go out and watch that. But what I want to do in this video is walk through how your tax on Social Security benefits are actually calculated. And if you understand this, there may be a few strategic moves you can make to get around some of it. But let me be real clear here at the beginning. I don't mean any of this as tax advice. Seriously, I have pros that handle my taxes, and if you have questions, you probably ought to have some folks on your team as well. That's not me. But what I can speak with authority on is the formula used by the Social Security Administration to determine how much of your benefit is included as taxable income. You know, benefits haven't always been taxable. If you go all the way back to Mr. Ernest Ackerman's payment of 17 cents back in January of 1937, all the way up to 1983, Social Security benefits were completely tax-free. But all of that changed with the 1983 amendments to the Social Security Act. Now, under the new rules, up to 50% of benefits became taxable for individuals that hit a certain income level. And then just 10 years later, the Deficit Reduction Act of 1993 expanded the taxation of Social Security benefits. And under those rules, an additional bracket was added where up to 85% of Social Security benefits could be taxable above certain thresholds. Now, the combination of these two laws left us with the current tax structure that we have on Social Security benefits. So somewhere between 0% and 85% of your Social Security payment is going to be included as taxable income. And in order to calculate just how much of your Social Security benefits will be taxable, you have to calculate a number called combined income. Now, this is a measurement of income used specifically for the purpose of determining taxable Social Security income. Now, this is often referred to in other writings as provisional income, but I'd rather just stick with what the Social Security Administration uses to avoid confusion. So throughout this video, I'm going to refer to it as combined income. Your combined income can roughly be calculated as your total income from taxable sources, plus any tax-exempt interest, such as interest from tax-free bonds, plus 50% of your Social Security benefits. So on your 1040 tax return, your combined income is simply the combination of your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. Now, once you've calculated your combined income, you simply need to apply it to the threshold tables to determine what percentage of your Social Security will be included as taxable income. Here's a quick look at those thresholds. If your combined income is less than $32,000, that's $25,000 if you're single, none of your Social Security benefits will be taxable. But the amount between $32,000 and $44,000 for married filing jointly and between $25,000 and $34,000 for singles is added at a rate of 50%. And anything more than $44,000, that's $34,000 for single filers, is added at an 85% rate. Now just understand, there are no tripwires where you cross a line and automatically 50% or 85% of your entire benefit is automatically taxable. This is a progressive tax where your benefits become more taxable as your other income increases. Now, I understand this can seem pretty confusing, so let's walk through an example to see exactly how this works. Let's take a couple that has the following income. Phil and Donna each have their own Social Security benefit of $1,500 per month, which works out to $18,000 per year, and combined, their total Social Security benefit is $36,000. In addition, Donna has a pension that pays her $24,000 per year, and Phil is taking out $20,000 per year from his retirement account. Their total annual gross income coming in is $80,000. So at this level of income, how much of their Social Security benefit is taxable? Well, the calculation is fairly straightforward. This is the combined income figure you need to calculate. The difference with this combined income versus their gross income is that it adds in only 1/2 of the Social Security benefit. So in Phil and Donna's case, you add only $18,000 of the Social Security benefits, plus the pension payment of $24,000, plus the retirement account distribution of $20,000 for a combined income of $62,000. So now you just need to apply it to the thresholds to see what percentage of the benefit is going to be subject to taxation. Now, assuming this couple is married filing jointly, we'll use the same threshold table that we just looked at a moment ago and work down the provisional income. And over in the far right-hand column, you'll see the results, which is the actual amount of Social Security income that's subject to taxation. So with the provisional income of $62,000 and this table, we can calculate the following. The first $32,000 of combined income doesn't have any impact, but 50% of the amount between $32,000 and $44,000 is added, so there's $6,000 added. This still leaves $18,000, which is added at an 85% rate, so $15,300. And if you add up the amounts from each of those threshold calculations, you get a total of $21,300 in benefits that will be taxable. For Phil and Donna, this means that 71% of their benefit will be treated as taxable income, just like earnings are treated or pension and IRA distributions are treated. So here's where I want your feedback. I would really like to know, do you think benefits should be taxable? And I want to see your comments below. So when benefits first became taxable, the change only affected the top 10% of retirees in terms of income earners. Now, that number today is closer to 60%, and that number is probably going to continue to increase because the brackets that determine an individual's income level is still set at the same amounts that it was in 1983 when the first law came out and 1993. And since then, wages have certainly increased, and this becomes even more apparent when you look at the revenue the Social Security Administration is collecting from taxes on benefits. It's doubled in the last 10 years. Now, there have been a few proposals to eliminate the taxation of Social Security benefits, but with an estimated $13.2 trillion shortfall between 2034 and 2092, I don't envision any proposal succeeding that's going to reduce revenues for the SSA, which, by the way, that's where these taxes go. They don't go back into the general fund to fund all of the government operations. They go back into the Social Security Trust Fund. The taxes on Social Security benefits, they're probably here to stay. But just because taxes are inevitable, you can still lessen the impact if you can plan around them. And I intend to do a video about this topic exclusively, but one of the most obvious strategies would be to simply lower your income, right? But that's not appealing or realistic for most people. The best option is probably to build a strategic plan before you retire. So, for example, distributions from a Roth IRA or Roth 401k are not counted in your provisional or combined income calculation. So you can have $1 billion coming out of your Roth, which is not likely. But if you did, that would not impact your Social Security benefit taxation at all. You could have an unlimited level of income, is the point, from those sources and still not pay tax on Social Security. Now, if you start now, you could be able to get your IRA and your 401k balances converted into Roth accounts. And I don't know if that's an option for you or not. It's absolutely something that has a number of factors that your financial planner or tax pro can help you unravel. You're going to certainly need to keep the big picture in mind when planning. And one thing's for sure, you don't have to be a tax expert to get this started. I know I'm not, but I do understand enough to know how to roughly calculate the amount of taxable Social Security benefits, and you should too. For anything deeper, go back and talk to your tax advisor. Hey, down below, I've put a number of resources for you to go and grab that are on this topic of tax and Social Security benefits. And so if you're on a mobile device, you can just click the arrow and it'll drop down and you'll see it there. Well, thank you so much for watching. Have a fantastic day.